Hello, everyone. It is very good to see you. My name is Mark Dolfini. I am with Strategic Boardroom. I'm the chief strategist founder, and it's good to see you. I'm really glad to be doing this. This was a pop-up session that I decided to do last minute. So I'm broadcasting this across a couple different channels, and I had it was a opening in my calendar, and I thought, you know what, I'm just going to go ahead and do this and answer some questions. I want to make this very relevant for all of you folks. And so I go ahead and put that in there. Like, please let me know where you're from and what line of work that you're in. Charlotte is saying I'm located in the Metro Detroit area. Oh, I'm just your neighbor to the south. I'm in Indiana. We're having a heck of a winter, aren't we, Charlotte? Yeah, it's been brutal. Recently began a small business that provides affordable home rentals to working class families. Very good. All right. So that is the line of work that I actually started in, was doing lower end type rental properties. And in my area, it did not work out super well. Just had some struggles. Most of it was just because I was buying properties that needed a lot of work, and I was undercapitalized, so I had lots of problems that I started out with. So I'm glad you got that. That's actually the reason why I wrote the book, The Time Wealthy Investor, and the Time Wealthy Investor 2.0 was to help rental property owners and not make the same mistakes that I did. So good for you, Charlotte. I'm glad that you're doing that. So if you are joining me today, let me know where you're from and what line of work that you're in, and we're going to get into this because there's a lot to cover in this session here. I know I've got some people watching on Facebook. I've got some people watching on YouTube. It is good to see you. And I am broadcasting also on Instagram as well. So give me just a second. Let me type this in here. I can't multitask because I'm a guy, right? We men don't multitask well. Oh, where you're from. There we go. So please let me know where you're from. And that is me saying that. All right, very good. All right, so for those of you who are just joining me, a couple of things too, just as a quick housekeeping thing. For those of you who are I've got a couple messages from some of you folks saying, "Hey, I want to make this, but I can't stick around. Is there any way I'm going to get a replay?" Yes, there will be a replay. This will obviously be on live. I don't know how long they're keeping lives up anymore on Meta. I think like they're keeping them for 30 days. I know it's kind of hard to track that. But also, Autumn, oh my gosh, it is so good to see you. Yeah, you're in Jersey, right? If I'm remembering right, I apologize if I get that wrong. It's very good to see you. I'm glad that you could join me. And if I think right, you're in the you do alterations. Yes. Okay. Yes, I am remembering you well. Okay. Yeah, it's really good to see you. I'm glad you can make it, Autumn. Well, thank you for joining me today. So we're going to get into this in terms of financial literacy. So here's what I want to do. We've got a ton of information to cover. Autumn, I don't know if you've been through this one yet. I know you've been through a couple of them. So Lauren is in Chicago. All right. You are my neighbor to the north. Lauren, I am just about 2 hours south of you in Lafayette, Indiana. So, let me know also what line of work you guys are in too, so I can kind of make this relevant for you guys. So glad you guys are joining me. Here's what I want you to do. I'm going to try to hit as much information as I can. And I have some natural stopping points baked in the cake for when you guys have questions. So just go ahead and type in your question, but make sure the question is fully relevant to like the full question. Don't just like, can you tell me more about that? Because that won't make any more sense 10 minutes after the fact. So if you have questions, type them out and I will get to your questions as you come up with them. And so just type them into the comments. And, and one other thing too, if you are signed up through EventBrite, I will be emailing you a copy of the replay. Like I said, like I mentioned, if you're watching this on Meta or on Instagram, I think they deleted after like 30 days now. I don't know. I think that's all across the board for lives, but it will be on YouTube. So if you'd like to go to my YouTube channel, you can find that there as well. All right, so let's get to it. So we're talking about financial literacy for business owners. Couple quick things too. Please don't try not to multitask. I know that you guys have a lot going on and you're trying to do this all the different business things that you've got going on, but just do your very best. Again, we're training our brains, right? We're trying not to get to do too many things all at one time. We're much more effective when we can be focused on one thing at a time. And not to mention, it actually, statistically, it actually adds to job satisfaction as well when you're not multitasking. So let's get to the agenda. So first and foremost, we're going to talk about the Viper framework. Then we're going to talk about the 4 core functions of business and then how those things relate directly to your financial statements. And then you might be saying, dude, where's all my cash? And this is a phenomenon called growing broke. So if you happen to be growing and in a growing business, but you're struggling for where all your cash is, you could be experiencing growing broke. And there's lots of ways you can grow broke. So we're going to be talking about one specific way, especially when we're in an inflationary environment. Then we're going to be talking about some resources that'll set you up for success today. That book I mentioned earlier, I apologize who that was that said that, Charlotte. So this book at the top right that you're seeing on the screen, that's my first book, The Time Wealthy Investor. That book's actually out of print now, but that was my first book. And I wrote that for mom and pop landlord investors who were really struggling with their business systems and architecture and things like that. So I since came up with an updated one. That's The Time Wealthy Investor 2.0. And all these books that I'm showing up there, you can actually get on Amazon. If you are interested, if you want to pay less and I can actually sign it and send it to you, you can find it. If you go to strategicboardroom.com, it's literally on the main page. Just click it. You can buy it here. But I'm not here to promote the book. I just wanted to bring that up because that is the foundation of where I wrote at a very deep level the Viper framework. And the Viper framework, it's an acronym for vision, infrastructure, process, execution, and reporting. So we're going to be spending the next 10 or 15 minutes on this, just so you can understand what this framework is all about. And this is a top-down approach to your business and to your life. So let's get started. Vision, first and foremost, has 2 components. It is made up of personal vision and business vision. Personal vision is just going to simply ask you a very simple question. Where do you want to go, right? Charlotte, where do you want to go? Autumn, where do you want to go? And it's not going to try to give any consideration towards how you make income, right? That's not really what that's about. Personal vision is really just going to ask you more of a question like, where do you want to go? Like, where do you want to go in life? So if you wake up with, say, $30 million in your bank account tomorrow, and $30 million is not a small sum of money, but you can't live a life like Justin Bieber. So after you go out and buy all the bougie stuff, realistically, from day to day, what would your life look like? Because you're still going to have to be a good steward of money, right? Otherwise, you're going to run out. So, Lauren has a comment here. Lauren, I'm a doctor of social work and own an aging life care management company. Oh, wow. Which I started late last year. Excellent. Wow, that's amazing, Lauren. Congratulations. I'm actually, right now, I'm in a PhD program for organizational psychology. So I've met a lot of people who are pursuing their PhDs who are also in social work. I give you guys a ton of credit for what you do. That's a tough job. So thank you, Lauren, for what you do and also for coming around today. Charlotte is, I'm having technical problems. I lost the feed. I see you, but the video ended and I'm just swirling now. I'm not sure. Is anyone else having issues? Let me just make sure that I'm not speaking to a blank crowd. Can anyone else see me? Okay. Just want to make sure that someone else can see me before I move on. Okay, Lobro, thank you, appreciate it. All right, so all right, thank you, Autumn. All right, so I got a couple people that can see me. So hopefully, Charlotte, you will be able to get that sorted out, because if not, you may just hang in there. You said you can hear me. It sounds like your video will come back. All right, thank you, Shalandra. All right, so personal vision is going to ask you a very basic question. Where do you want to go? Where do you want to go in life, right? What do you want your life to look like? What do you want your relationships to look like? And if you're looking at this from that personal vision perspective, then you can look, once that's defined, then you can start to reverse engineer a business. And that business vision is going to say, cool, that's where you want to go. How are we going to get there? And that's what the business vision will do. And there's been many times where I have worked with folks who've never really given any consideration to a personal vision whatsoever. It's all been about their business vision. And the danger in creating a business vision without ever giving any consideration to a personal vision is that you end up creating a life that exists to serve the business. And I'm just telling you that that sucks. Like, I've been down that road and spent a decade or more chasing that business vision and you're like, hey, let me make 50 grand or 100 grand a month, and then I'll worry about that better life thing. And I was just telling you, like, I chased it. I was just chasing a ghost. So I'm not going to spend a ton of time on this because I do want to get the financial literacy piece, but I always have to remain in integrity and bring this to people, because this might be the only time they actually hear that, is that personal vision is very important. And think about this in the context of like a 100th birthday speech. You know, who would you want to be in the room, and what would you say to the people that were in the room? Okay. So I'm not going to get any further deeper on this. I do other things, other webinars around where this gets a little bit more unpacked. But just for right now, please take the time to say, like, what do I want my relationships to look like? What do I want my relationship with my spouse to look like? My relationship with my children, my mother, my father, my children, my siblings. Think of those things of who you would want a deeper relationship in your personal vision, and start writing that stuff down. Because if it's not written down, you're never, from a 1 to a 10, you're never going to be more than a 5. All right. So let's get into the business stuff. So thank you for that few minutes of that. So the business vision is really going to be important because it's going to dictate how efficient your dollars are working. So these 3 C's are really more about the DNA of your company. So the DNA of your company is fabricated by these 3 things, and that is your core purpose, your core values, and your client avatar. Those 3 things is what helps define the culture of your business. The culture, the DNA, basically how you do things. It's the basic construct of your business. So let's first look at core purpose. Core purpose it's simply going to ask, what business are you in and what problems do you solve? And you have to be specific about each one. Be really specific about what business that you're in and what problems your business specifically solves. Okay, yeah, that might work out, Charlotte. All right, well, yeah, we'll keep things rolling, but you can get this on the replay too. So the thing is, you really want to take the time to get really clear about what business that you're in, and almost be exclusionary to what business that you're not in. And I know for a lot of what's the word? The entrepreneurs, the serial entrepreneurs that are out there, that hate to say, well, I don't want to limit myself. I want to make money all these different ways. The problem is that they're not creating businesses. What they're creating is jobs. They're creating jobs for themselves. If you're creating jobs for someone else to do, fine. But if you're creating jobs for yourself to do, that is not fine, because that's just going to make you very, very fragmented. And that's going to make your results also very fragmented. So get really clear about what problems that you specifically solve and what business that you're specifically in. All right. Next is your core values. Your core values is what matters to you about this business, and how would the world be worse off if you were no longer in business? And I know this sounds like super squishy, like, oh, geez, I don't really want to talk about core values. I get it. I do get it. I was kind of more like, all right, can we get to the meat and potatoes, or really what, around business? Here's the thing that I didn't understand when I first heard this. And I wished someone had told me this earlier. But the core values of a company it comes from the founder or the founders, right? The core values of a business is really just an extension of you, because your business is just an extension of you. So if you have to think about this, that the core values is what helps determine company culture. And your company culture and your company brand are inextricably linked. Think about it. Your company culture is what your employees and your vendors experience. Your company brand is what your customers experience. So those 2 things, the company from the core values, you're looking at organizational culture, and so company culture and company brand, right? Those 2 things are what are defined by your core values. So think about this from the perspective of like what things are important to you, and we learn our core values by our excesses. And someone thought one time I had misspoken and said, "Oh, you learn from your exes?" I'm like, "Well, technically, yeah." And I'll tell you why that's actually kind of a funny analogy. If you have an ex, right? Say ex-boyfriend, ex-girlfriend, whatever, and that person is likely an ex because they were not aligned with your core values, right? Even if they broke up with you, right? There's a misalignment of core values, and maybe down the road you're like, no, they were a good person, and maybe I just wasn't a good fit for them, or maybe I got dodged a bullet, right? Anybody have those, right? Where I definitely dodged a couple of bullets. Those are really important because there's just a misalignment of core values. So when you or you have a friend that you have to let go because they're wandering off the reservation, they're wandering down a path that you can't follow, those violations are really, really important. So think about those when you're trying to define the core values of your business. The last component is your client avatar. So we talk core purpose, core values. Now let's talk client avatar. Your client avatar is who specifically and ideally do you want to serve? Now, you might be thinking, what does this have to do with the price of green beans when we're talking about financial literacy? It all matters. And the reason why is because when you're spending money on lead generation or trying to compensate your salespeople on the best way of doing that, you want them to be efficient, right? Well, if you're not defining these things, especially with your client avatar, and you're just trying to advertise to everybody, it's really hard and really expensive to advertise to everybody because everybody's got different, they represent different client avatar. So this is where I want you to break them down between geographics, demographics, and psychographics. The geographics is where they are. The demographics is who they are, right? Are they married? Are they single? Are they educated? Are they not educated? Are they young? Are they old? What are the demographics that they represent? And finally, what are the psychographics? And that's how they think and how they buy. So when you're thinking about this in terms of psychographics, I want you to think of ALIA, ALIA, their attitudes, their lifestyles, their interests, and their aspirations and goals. And when you know this, and your salespeople know this, and your marketing people know this, and you're going to send, and they're trying to convince you to send out $5,000 worth of marketing dollars, and you have to respond back and say, well, I don't really know. How well do we have this avatar dialed in? Then you can be much more intentional about the marketing dollars that you're sending out. Something that I like to track is known as RMI, return on marketing investment. So if I'm sending out $5,000 in marketing dollars, how many of those dollars are going to bring back $1 under each arm? Right? How many of them, are they going to bring back 5 under each arm? Right? That's your biggest return that you're ever going to get is from your marketing. It should be. If you're sending out $1 and you're only getting $1.10 back, it's not bad, but your marketing dollar should be sending, if you send out $1, they should be bringing $10 and $20 back. That's ideally what your marketing, your RMI should be. It should be multiples, not just mere percentages. So those are the 3 C's of business vision: your core purpose, core values, and client avatar. So, and that wraps up and puts the fries in the bag for the vision component. Again, you got personal vision and business vision. Now we're talking infrastructure, the bones of the business, right? These are the desks, the chairs, the software, things like that, right? Websites. Now, for those of you, again, you're here to learn financial literacy, part of your infrastructure needs to be actual accounting software, not just what you're doing on an Excel spreadsheet, but what you're actually doing in, it could be, there's all sorts of different accounting software. Personally, I like QuickBooks. I like QuickBooks Desktop, but QuickBooks has QuickBooks Online. They have QuickBooks Enterprise, all sorts of different, I think Xero's got a product out there. There's all sorts of different products. But my point is, when it comes to the infrastructure, you have to be thinking of what type of infrastructure you're going to be putting in place for your financial component. Okay, so if you don't have that, you might need to spend a couple bucks, and that's just what it takes. Don't go cheap on this. You want to be good enough, and for most companies, especially smaller companies, QuickBooks Online is fine. I'm not a big fan of it. I think it's okay. Like, I'm just not a huge fan of it. I'm much more of an accounting purist. That's my background. That's my degree. And I really like QuickBooks Desktop, but to be honest with you, it is expensive. I'm not gonna shortchange that. So that's the Viper framework from vision and infrastructure. Now let's look at process. Process is simply how you do stuff, right? It's, from a tactical perspective and a strategic perspective. There's two perspectives of process. And process is basically how you do things from, tactical part of process, rather, is how you do stuff from your standard operating procedures, your checklists, right? Your day-to-day things. That's your tactical day-to-day stuff, right? It's your opening procedures and your closing procedures. It's how you reconcile your checking accounts, right? How you prepare your bank deposits. Those are all things that you need to have written down so that you can turn that over to someone else to do. Okay, these are the sorts of things that you need to start thinking about as a business owner, is this tactical day-to-day stuff. Now, this also includes other aspects of your business. We'll talk about that here when we get to the 4 core functions. But I just want you to start thinking about from the tactical day-to-day stuff. When you're looking at strategic planning, which is the other side of process, that involves people, purpose, and promotion. I'm not going to spend a ton of time on this because it really isn't relevant to the financial literacy piece at all. But just understand that when you're looking at strategic planning, you're looking at your infrastructure and your tactical part of process as the boat, right? That's the battleship. And strategic planning is what you're going to do to take the boat out of the harbor, right? So you're not just moored at the harbor and just getting blown around by the economic winds or whatever happened to show up. Does that make sense? So it takes people outside your organization, and it also takes people inside your organization. Right. And those people outside might be the people that you're marketing to, right? I mean, it might mean a new market. It might mean that you're bringing on additional suppliers, different vendors. People inside your organization could be your accounting, your accountant, your bookkeeper, things like that. What's the purpose of the strategic plan? The strategic purpose might be to expand market share, right? So you're going to be investing money to expand into market share. That's a financial literacy decision. Right? So thinking about it from that aspect, the strategic purpose needs to be in alignment with what? It needs to be in alignment with your core purpose, right? Because if it's not in alignment with your core purpose, sorry, I've got a worse frog in my throat. If it's not in alignment with your core purpose, right? That's how you wander too much. That's how you get shiny object syndrome. That's why when you first start out in endeavor, it's really exciting, and all of a sudden you start hitting some rough patch in the road, and you're like, man, I'm just going to wander off and start chasing another rabbit. Ask me how I know. So that's why I'm saying, like, you really need to have a strategic purpose that's in alignment with a core purpose. Otherwise, it'll be like Starbucks starts selling chainsaws. It doesn't make sense, right? Starbucks sells coffee. It doesn't make any sense for them to start selling chainsaws. That's when you have a strategic purpose that's not in alignment with a core purpose. So that's why you have to define those two things. Then the last piece is promotion. Promotion is just letting people know who's doing what, right? Like, you're communicating outwardly to the people that you're trying to promote to, but you also are promoting a lot inwardly, right? The suppliers, the employees, right? And promotion is it's like communication, but communication is just telling someone once, right? Promotion is telling them over and over again. Does anybody have any teenagers? Right? If you do, you know what I'm talking about. All right. So that is the purpose, or I'm sorry, that is the process, right? Tactical and strategic. The next piece is execution. Execution is a good plan violently executed now is much better than the perfect plan executed next week. It's a brilliant quote by General Patton. Look, sometimes you just got to get up and do stuff. And the reason I have this defined is because most plans fall apart in execution. And I know you folks out there who have 37 to-do things, to-dos on your to-do list today. And, right? And the reality is you're not going to get them all done because you have too many priorities. And having too many priorities has the same impact as having none. So that's where I break things down into a daily 5. And that daily 5 is up to 5 highly specific actions that you can take that are going to move the needle towards your vision or your strategic plan, right? So that's why I like to boil that down into my daily 5. Like, what are the actions that I'm going to take? And that leads us to our final one, which is reporting. And that comes down to lead metrics and lag metrics. Our lead metrics are based on our actions and activities. That's it. There's really nothing more than that. They precede the results, right? That makes sense. The lag metrics are the results of those actions and activities. So if you don't like the results, what are you going to change the results? You're going to move the goalpost? No, you're going to look at your actions and activities. So that's really, really critical when you're looking at all four of those things, or all five of these. When you're looking at vision, infrastructure, process, execution, reporting, that all ties together. All right. And that is the Viper framework. That's the Viper methodology. So now let's look really quickly at the four core functions of business. And this is really important because when you're looking at the four core functions, they involve these four things: lead generation, sales, operations, and accounting. And your customer's journey through your company happens in that order. First lead gen, then sales, then operations and accounting. So I want you to think about this when you're having conversations with people outside your organization. It starts in the lead gen, and then it'll flow naturally into the sales conversation where the sale gets closed, and then it gets handed off to operations and fulfillment. The job gets done, whatever needs to get done, and then finally is the accounting portion, which is where you get the money, right? And that's kind of important. But let me just make this quick point around lead generation, and then we're going to get into the accounting function. Lead generation, everything needs to support your lead generation function. Everything. Because you can have the best, most efficient business. You can be a paragon of virtue. Your sales techniques so dialed in, you can sell ice to Eskimos and voting booths to Castro, and you can still starve. So you can never, ever, ever take your foot off the gas when it comes to lead gen, right? Because that, without lead generation, you're out of business. Your sales function just continues on the conversation that started in the lead generation function. And it understands that effective selling is about finding solutions, not holding people's heads underwater until they say yes. So, I see you, mate. Thank you, Mick. It's good to see you. All right. Join us on Facebook, Mick Jackson. I see you, mate. Avon Lake, Ohio. Excellent. Charlotte made it back. All right, good. And hopefully you're able to see us. Sorry you were having some technical difficulties there. All right. So this is really important too when you're recognizing the operations function. So you had the lead generation function, you had the sales function. Now you've got the operational function. If you're going to get stuck in the operations, if you're going to get stuck anywhere, generally you're going to get stuck in the operations. You're going to get stuck fixing the cars, putting on roofs, building websites, whatever the thing, right? That's generally where you get stuck. If you're going to ignore something, it's generally the accounting function. And it goes something like this. Well, I've got more money in my bank account this month than last month. I must be doing okay. That sound familiar? And I'm just letting you know, there's no judgment here. I'm just letting you know, like, I have an accounting degree and I have said those very words. So I'm just telling you, the accounting function cannot be ignored because it's the function that collects the money. How many of you like money, right? Like that's it. Oh, it's Duff. Oh man, good to see you, brother. I didn't recognize. So, John Duffy, I'm not sure what you're going by these days. We flew on C-130s together. It's good to see you, man. Yeah. All right. We'll have to connect. I'm glad you can make it. So the accounting function, it obviously collects the money. The accounting function also pays the bills. And the accounting function tracks and measures everything that happened. But more importantly than all of that, which all of that is extremely important, it also forecasts, it budgets, it plans for what's going to happen next. So you have to think about this from a hot second. Are all of these four things the same skill set? No, they're not the same skill set. That's why you have to define your core values so you can hire people that are going to be that will align with those core values. You want to define your core values so you can hire people who are in alignment with those core values so you can start handing some of this stuff off. Right? So think about that from that perspective as we wander into the financial statements. So the financial statements, as we get into this, and thanks, Jack. It's good to see you. Great show. So I want you to think about this from a financial perspective. And here's what I'm going to say. Where are my numbers people? Are you a numbers person or not a numbers person? So go ahead and write it in the chat. Are you a numbers person or not a numbers person? And I'm going to tell you this. As you're going ahead and typing that in, I'm going to take a quick sip of my drink, try to clear my throat. Here's the thing. Whether you are a numbers person or not a numbers person, I want to tell you something. Accounting and bookkeeping isn't about numbers as much as it is about rules. So if you can play solitaire if you can play Candyland, if you can play checkers, you understand enough to understand the financial statements. Because it's about rules more than it is about numbers. Okay. So it communicates that in numbers, but I wanted to make sure that you understand this. Okay. So the financial statements, now for those of you who have been down this a little bit, like this might seem a little basic, we're going to get to some more advanced stuff at the end when we're going to start talking about percentage of sales method. We'll get into that. But if you can operate a 4-function calculator, you can understand this stuff. So the financial statements, there are several financial statements. The big thing, number one, is balance sheet and income statement. Now I'm going to make a big point here is that if you hear income statement or P&L, they are the same thing. Income statement, profit and loss, P&L, they are all the same thing. So if you hear someone say that, I just want you to understand that they are actually asking for the same thing. I'm an accounting purist, if you will. So income statement is something that that's the vernacular that I use. There's two main differences between balance sheet and income statement. I'm gonna unpack each one of these. The balance sheet is a snapshot of that business in time, and it measures all of the balances in their account. That's basically it. It measures the balances in all their individual accounts. The income statement basically is over a period of time, and it's going to be tracking different things, and but it's over a period of time. So it's again going to give the sum total of all the activity in each of those individual accounts. So this will make more sense here in a little bit. So let's look at balance sheet first and foremost. Balance sheet is made up of three things. A balance sheet is made up of three things. It is made up of assets, which is what is owned by the company, liabilities, what is owed by the company, and the equity, what it's worth on paper. So conceivably, if you have assets minus liabilities, what's left over is the equity. What's worth on paper is the equity. So you take the assets, subtract the liabilities, what's left is the equity. So that's the balance sheet. And that is, again, at a snapshot in time. So again, generally you're going to see these at the end of the month, but you can run them at any time. But generally you're going to see them every month when the accounts have all been reconciled, right? When basically say, yep, there's a reconcile. We're going to lock the balance sheet and an income statement. Nothing else can be changed. And so you might see one that's at the end of October, 10/31, or an 11/30, which is your end of November. You're right, your 12/31, which is the end of December, right? Now let's look at the income statement. The income statement would be over a period of time, which might be 1 month or 1 quarter or 1 year, right? Your income statement is made up of three things as well. The balance sheet was made up of assets, liabilities, and equity. Your income statement is made up of revenues, expenses, and net income. So when you're looking at your revenues, expenses, and net income over a period of time, you're thinking of your sales over 1 month period, for example. So from 10/1 to 10/31, that's the month of October. What are your total expenses during that same period? And then whatever you take your revenues minus your expenses and your net income that's left over is your profit. So let's look at, I'm going to take myself down off of this so you can see this. And this is actually excerpted from my book, The Time Wealthy Advantage, from page 265. So for those of you who have the book, you can actually see this. But if not, you can just follow along on the screen because I have that already baked in the cake for you. So this is what we're looking at. Again, we're talking about financial literacy for business owners here. And this is a very basic balance sheet. Your assets at the top, your liabilities in the middle, and your equity, which is the assets minus the liabilities, which is the total equity. So let's look at the top section first, which is your assets. Your assets, again, this is what you own. This is what you own. So again, you own the cash in your checking account, right? Which is $10,350. So again, if this was the balance at the end of the month, this would be the balance that's reported. Accounts receivable. This would be if you're selling on credit. So in other words, let's say that you owned an HVAC company, or a plumbing company, or maybe you're a florist, and you sell your stuff, but you don't get paid right away, right? So you sell your, whatever it is, your product, your service, but you don't get paid right away. You get paid in 30 days or 45 days or whenever people get around to sending you money. So if you are a cash business and you get paid right away, there wouldn't be any accounts receivable. But if you sell on credit, and many businesses do, your total balance of all of the money that people owe you would be $101,275. Now, just real quick, I know there's a lot of people here from the States, from the United States, but if you're watching this either on replay or right now, and you're wondering, well, does this apply to me if I live in a different country? Yes, because what you're learning here is what's known as generally accepted accounting principles. It's known as GAAP. So when you're learning GAAP, generally accepted accounting principles, this is pretty well universal from an international perspective. And they had to come up with rules like this because otherwise people could report these things in all sorts of different funky ways. So I just want you to understand that. So let me get back to it. So you got your accounts receivable. And again, these things are listed on your assets from most liquid to least liquid, meaning how quickly can these things be converted to cash. So you've got a vehicle that you purchased for $29,970, and that is listed at what's called book value. That means what you paid for it, not necessarily what Kelley Blue Book value is or what someone else tells you it's worth. It's what you purchased it for, and then that would be amortized or depreciated because it's a physical asset. It would be depreciated over its useful life, but I'm not getting into that. So I'm just letting you know that's listed at purchase price. And the same thing with that real estate, right? You've got a real estate warehouse. You purchased it for $275,500. So that's it from top to bottom. And most liquid, most convertible to cash to least convertible to cash. And your total assets equals $417,095. All right. So that again is what's listed at the top section of the balance sheet. Let's look at the bottom section. And that's your liabilities and your equity. So again, from here, it's just your shortest term debt to your longest term debt. You've got your credit card balance with Chase of $34,760. You've got your accounts payable, who you owe money to other vendors, and that could be multiple vendors. That's amount of $37,500. And again, that's if you're buying from vendors on credit. So in other words, you're taking in supplies and you're not paying them right away. They're extending you credit. You've got a loan with Wells Fargo or whatever or whomever to purchase that van. You only owe $11,570, and then the same thing with the Citibank real estate mortgage for that warehouse, $105,350. So you've got your total liabilities of $189,180. Then you take your assets of $417,000 minus $189,000. And that equals just under $228,000 in total equity. So again, conceivably, if you took every single asset that you had and liquidated it, sold it, and paid off all the liabilities, that's what you would have left over, right? And that's conceptually, right? You obviously have broker's fees and things like that. But I'm just saying, and realistically, your van isn't going to be worth $30,000 anymore because it's obviously, it might be a few years old. So it's just this is your total equity based on your balance sheet. So now let's look at your income statement. Your income statement is your P&L. Again, we're talking revenues, expenses, and net income. So let's get to it. So I'm going to, again, take myself down so you can see this. And at the top, you've got your revenues. At the bottom, you've got your expenses. And then you just subtract the two. And now you have your net income. So let's look at that. The very top section is you got your product sales of $75,000 and you got service sales of $39,000 for total sales of $114,000. Now, why would I care to split those off between product sales and service sales? The reason you'd want to do that is because you may want to track where your money is coming from, where your higher margins are. So let's say, for argument's sake, that your higher margins are in your product sales. So you'd want to increase your product sales as much as possible, or over a certain percentage of sales. So if you look off to the right there, where you see your out of 114,000, see where it says 100%, and that's 100% of sales, right? 114,000 divided by 114,000 is obviously 100%. So if you look at service sales, 39,000 divided by 114,000, that's 34.2% of total sales. And that's called the percentage of sales method. Keep this in mind because we're going to come back to this later on when we start analyzing our financial statements. This is a very, very valuable and effective tool to know how well you are doing inside your organization. So keep this in mind. Keep that in your hat. We're going to come back to that one. So that is your total revenues. Let's look at your expenses. Your expenses at the bottom part of the income statement made up of various things like raw materials, like you're buying raw materials that you are having to make your products with, right? This is the expense. So over that period of a month, you bought raw materials. Over that period of the month, you paid for insurance, you paid out interest, right? You paid out commissions to your salespeople, and then you also paid out wages. Okay. And again, if you look to the right where you see that 29.8% or 4.5%, that's divided by the 114,000 in sales. Again, you're tracking this from what's known as a percentage of sales method. Okay. And you when you get to the bottom there, you see net income. You made $17,680 in that month after all the expenses were paid. So not bad. You made a decent little profit. Okay. So that's your income statement. Now, you might be thinking, well, okay, what does all this mean? Why does this matter? And why should I care? I'm going to tell you. And the reason why is because now we're going to start to get into the real meat and potatoes of where all your cash is going. And you can start planning your growth, because you cannot be strategic if you don't know your numbers. And you also want to make sure that you avoid growing broke. You may have a growing enterprise and you're actually making less money. And sometimes you're growing and you're not even making any money. You're actually growing, but you are actually making negative dollars, which means you're actually operating in a net loss. So let's understand what that is. There's 3 key metrics that I want you to pay attention to. And these are the metrics that are going to be a little bit more advanced for those of you who are trying to get an understanding of just true financial literacy. So number 1 is profit margin percentage. The other one is cash balance history. And the last is cash as a percentage of sales. There are plenty of other metrics that you can track. And, as a current ratio, liquidity ratio, I mean, you could literally slice and dice thousands of metrics. And I'm not getting into all of them. I'm just getting into these 3. To me, these 3 are always ones that I'm always going to track personally. And you're going to understand why here in a second. So let's go back. First, we're going to do the profit margin percentage. Let's get into this one, because this one is probably the most important in my mind. Well, they're all important, but this one's really, really critical. So let me get myself down at the bottom of the screen again so you can see this. So if you're looking at the right side of the screen, I'm going to go ahead and circle those numbers. Those are the percentage of sales. So again, you're looking at total sales of 114,000. And again, let me just go back and look at this number at the very top. And that's what we're looking at, is that 75,000 is 65.8% of 114,000. Your service sales are 39,000 divided by 114, which is 34.2% of sales. Okay. This is important to track, just like I mentioned before. So again, you're doing the same things, and you're going to do it with your expenses. And before I go on, I just want to make this quick point. So imagine, you might be thinking, well, why does this matter? Well, let's pretend that your sales let's say your sales go to 150,000. Okay. Your sales go to 150,000. Would it make sense for your raw materials also to increase? Yeah, it would make sense that your raw materials also increase, because you're using probably more raw materials. That makes sense. But let's say your sales go to 150,000 and your raw materials go to 70,000. So basically your raw materials doubled. It went from 34,000 to 70,000. Okay. What is the numbers that you would be expecting to see with your raw materials? So let me do the math real quick. So if you've got 150,000 divided by 70,000, oops, sorry, I did that wrong. Did that backwards. 70 divided by 150. So as a percentage of sales method, your raw materials went up to 46.7% of sales, up from 29.8% of sales. Well, now you have real numbers to track. It's not that the fact the raw materials went up. You were expecting it to go up. You weren't expecting it to double. So that's now going to give you a real way to compare apples to apples when you're comparing period to period. So you can actually track your numbers and go, oh my gosh, yeah, why did my wages go so high? They were at 39.5% 45% of sales, and now they're at 48% of sales. Why are my wages going up so much? Well, maybe you're using more overtime. Maybe you need to hire some people so you're not paying so much overtime. Make sense? Or maybe you need to sub that out to vendors to handle some of your overflow, right? There's other strategic ways to do this, but you can't be strategic if you don't know your numbers. I'm going to look at the bottom of this, and I'm going to circle. See where it says 15.5%? That's really important. That's known as my profit margin percentage. My profit margin percentage. So let's take a look and see how this is really important to what's going on in my business. Let's pretend you have a business and you, in 1 month's time, you have $10 in sales. $10 in sales. Your expenses are $8 and your net profit is $2. 10 minus 8 equals 2. Your net profit margin percentage is 20%. It tracks pretty easy. Now, let's pretend that your expenses go up $1. So your expenses go up $1. Your expenses go from $8 to $9, but you still want to maintain that $2 profit margin. Okay, so in order to maintain that net profit margin, you're going to increase your expenses. Your expenses went up to $9, so you're going to increase your sales. You're going to increase your pricing $1. So your prices go up $1. So now you have a net profit of $2. 11 minus 9 equals 2. Except what happened to your profit margin percentage? It declined. It went down. Your business is now less efficient at keeping money. Your business is now less efficient at keeping dollars in your organization. You're actually making less money because the money that you can buy with $2 is worth less. So what would you actually do to maintain your profit margin percentage of 20%? Well, you would need to increase your revenues by $1.20, not just by $1. So now you go from $11 to $11.20 minus 9. Now you have a net profit of $2.20, which brings you to a net profit margin percentage of 20%. This is how companies grow broke. They're increasing their revenues. Let me get myself back on the screen here because I'm going to make this really profound finger wagging. Here's the reality. If you're growing your revenues, but your profit margin percentage is declining, this is how companies grow broke. And I'm telling you, there's lots of ways for companies to go broke. This is probably the more common one. And the reason why is because so many business owners have a bad relationship with money. They feel bad about asking for more money from their suppliers, or from their customers rather. They feel bad about when a supplier comes to them and asks them for more money, and you're like, dude, like, and they just go, oh, okay, right? Like, again, if prices have to go up, that's fine, but make sure you understand why, right? Reasons build trust. Understand why, and then pass along those price increases by the same margin to your customers. It's not your job to buffer them from that. You can, I mean, if you have lower prices and you're trying to maintain a certain margin, that certainly has worked well for Walmart, but you don't have the pricing power of Walmart. You don't have the infrastructure of Walmart. So you really have to make sure that you're always increasing your prices to maintain your profit margin percentage. That is how you'll prevent from growing broke. All right, so let's get to the next component of this. So the last piece of this is different resources, and around understanding, we looked at profit margin percentage, and now we're going to look at cash balance history and cash as a percentage of sales. So the cash balance history is really not that complex. If you look at the little graph here that you created, all you're doing is just tracking those numbers from month to month. I think from a weekly basis is probably overkill, but making sure that at the end of the month, when your balance sheet is all reconciled and ready to go, and I don't even care if you log into your checking account and just you're not there where you're doing reconciliations each month, but just at least track your cash. Because if you're like, oh yeah, I log in every day. Yeah, logging in every day is a very different bird than actually tracking it. Logging in and checking it every day is not tracking it. Checking is not tracking. So you have to make sure that you absolutely have a one one graph that you can go to see the trend of your cash. And if that cash is not going up every single month, that is a problem. Like, I don't care what it is I have to do. I want to make sure that my cash balance goes up every single month, because when you have cash, you have options. And every business that I have worked with that has really struggled has not had enough cash. They have run themselves way too low on cash, and as a result, they have not left themselves with options. And when you don't have options, man, you get really desperate and you start taking on customers that you don't want to do. You start offering products and services you don't really want to offer, things way outside your core purpose, which you heard about in the 3 C's of business vision. So this is really important to consider when you're tracking these individual metrics. Let's look at the next one, the last one here, which is your cash as a percentage of sales. Now this one, it's going to take a little bit of math to get here, but it's a nice, easy calculation. Just one divisible calculation, but I promise you it's pretty easy to do. So let's look at this. What we're going to do is we're going to have to look at 2 different financial statements. This is really super simple. Let me get myself down. We're going to get these numbers from the balance sheet, and we're going to get this from the income statement. So presuming that your business cycle, most business cycles, not every one, I mean, most business cycles follow a 30-day cycle. So if you have a 30-day cycle, which means generally that's when your revenues come in over that period of the month, you pay out your bills over that period of the month, right? Generally, a lot of businesses have a 30-day cycle. You might have a farming operation, which might have a 6-month cycle, right? You might have a hog operation that has a 9-month cycle or whatever. But I'm just saying, like, you want to make sure that you understand your business cycle here. So does understanding how the money comes in. So what you're going to do is you're going to go to your balance sheet and you're going to take the cash balance. You're going to take the cash balance from your checking account. And in this particular case, it's $10,350. You're going to go to your income statement and you're going to grab the number off of there, the total sales of $114,000. And you're going to divide that $10,000 divided by $114,000 to come up with a cash as a percentage of sales. Now, what does this mean? Cash as a percentage of sales. I want you to think about what these metrics represent. Don't just go blindly and think like, well, what does that mean? 8.7%, is that good? Is it bad? It's not anything. It's a data point. Data only matters when it's compared to other data. So you'd say, well, hold on a second. If I've only got $10,000 and I bring in every month $114,000, that seems low to me. Yeah, that seems low to me too. Because if I've only got $10,000 in cash at the end of the month and I'm bringing in $114,000, what happens when my sales go to $160,000 or $170,000? I'm not going to have enough cash to fund that growth. Make sense? So I always want to see this number increasing as long as sales are stable or increasing. And the reason for that is because if sales are going down and my cash stays the same, that percentage of that cash as a percentage of sales number could actually be going up. Makes sense? So because you're dividing it, because it's the bottom number. So I just want you to think about this. So when you're thinking about what the number represents, this is where I also put this on a chart, on a graph. And I want to see that cash as a percentage of sales. It's 8.7%, 9.2%, 11.3%. So again, as long as sales are increasing or are stable, that generally means that my cash is also going up because my cash is increasing. So you just have to understand the math. That's all, right? Again, you can understand rules, but the reality is you cannot be strategic if you don't know your numbers. And this is all very critical to avoid growing broke, right? Here's a couple of success strategies. If you guys have any questions, go ahead and type them into the chat. Go ahead and do that now. And I'll stick around and answer a couple of questions if you guys have them. But here's the reality. Go ahead and plug that in now because I'm going to share some different things that you guys can utilize as tools in your toolbox. But from a success perspective, you have to know your numbers. There's just no getting around that. And you also have to track your numbers. You can't just log in and glance at your numbers every now and again and just see that they're okay. You really have to track the trend. Otherwise, you're going to be like, wow, yeah, look at the water, coming in the boat, right? And if you're not tracking that, you're like, oh my gosh, my boat is sinking and I didn't ever really pay attention to it, okay? So as you guys are typing out your questions, I want to show you one quick thing. So this is a picture of a bank robber, and you can't really see him. In fact, let me just go ahead and take myself down. But what happened here is this guy and his accomplice thought it'd be a great idea to rob banks without making any attempt to cover their faces. Well, of course, they got caught like a couple days later, and they were completely surprised that they got caught. Well, the reason they were so surprised is because, of all things, they rubbed lemon juice on their face, absolutely convinced that they would be invisible to the cameras. Not kidding. They absolutely thought this. So when two psychologists said that we've got to investigate this because there's no way this is true. Well, what they recognize is that when people start out on an endeavor, they have two different axes or two different components that are at play in their endeavor, right? They have confidence and they have competence. They're very confident very early on, which you'll see they start down here on this little circle, and you see the confidence spike up really fast until they get to something known as the peak of Mount Stupid. And what happens is they start to realize very quickly, right? They're like, oh my gosh, how hard could this be? And then they realize very quickly that they don't know what they don't know. So they start realizing, oh my gosh, there's things I don't know. And they come crashing down into the valley of despair. So they've increased in competence a little bit. They've got a little bit of experience, but their confidence is taking a real hit because they have failed miserably. But if they keep at it, if they keep building on their competence, if they build in their knowledge, they start getting more confident as they head up the slope of enlightenment, and finally they get to that plateau of sustainability. So the reason why this is so important is because down here, and the reason I bring this up, in this valley of despair, the reason I bring this up is because a lot of business owners, this is where they give up. And they're like, oh my gosh, I'm so frustrated, right? And they wander, and then they go find something else to chase, right? And this is also why, I think people give up in marriages and things like that. But realistically, this is why it's important to have a support system. So what I'm going to offer you guys and gals is, if you'd like to join me in my community, I'm going to go ahead and put this in here. There is absolutely no cost to join. And this is Strategic Boardroom on School. And we just have conversations in there from time to time. Sorry, my notes start to run all of a sudden. And there we go. So if you guys would like to join me there, you're more than welcome to. Like I said, there is no charge for that. I don't see any questions. I'm really okay. I don't see any questions, but thank you guys so much for hanging around. I know this was kind of a pop-up, and I just kind of do this on short notice. So thanks for stopping in. And for those of you who joined me on Instagram or YouTube and Facebook, thanks for stopping by. I really appreciate it. Good to see you guys. And if you would like to join the community, you're also welcome to join there as well. For those of you who did join through EventBrite, you will be getting a copy of this replay sent to you in your email inbox in a few days. Thanks so much for hanging around, and I'll see you guys in the boardroom. Take good care.